What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is September 26th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Monday, we've got a special episode where we're going to be talking about trying to make the case for our 10 to 14K target for Bitcoin potentially being a really solid range to start accumulating and dollar cost averaging. This mainly has to do with a couple key things. We'll dive into why we believe this is the answer for where Bitcoin could be heading as we dive into the equity charts, which are spelling for a further correction, some of the more optimistic indicators like the Dixie and commodity-based prices that are signaling potentially for the bulls, but wrapping up the conversation here in our response to the recent comments from famed Wharton professor Jeremy Siegel on Jerome Powell and the Federal Reserve's approach to monetary policy. We've got a lot of things to dive into in today's video, but let's go ahead and kick off the conversation. Now, first off, I want to go ahead and talk a little bit about our target range here for Bitcoin. Not only, as we talked about in our previous Macro Monday, do we have some key signs here that have got us concerned for the future of Bitcoin. We broke down to our target of 18,800, and this likely signifies, as we've come down to retest this low here and are not holding the level very well, that we are likely going down towards the next major range, which would be $14,000. But most importantly, the 200-week EMA and moving average are serving as clear resistance rather than historical support, which it's done historically back in the past. This is, again, still the biggest warning sign here from a technical analysis standpoint. The 200-week, whether it be the exponential moving average or moving average, is a very significant indicator. And it's usually where people come in to buy Bitcoin in typical crypto bear markets. And this leads to my point here, that we are likely at the end of a secular bull market, that Bitcoin essentially over the last decade has essentially been in a consistent bull market with exacerbated corrections, these 80% plus pullbacks. We have yet to really experience a depressionary bear market for Bitcoin in cryptocurrencies. And I think that that is what we're likely stepping into here, where we really start to deviate away from the long-term parabolic uptrend and start to have a bigger extended correction before we really have the foundation to move higher here. Now, if we can see here, we're just asking at a minimum, if we go to 14K, for the typical 80% correction. And that's why we've got that as our first target range here. But in between there, around price levels like 12,000 and here at 10,000, these are going to be additional levels where we can get more confident about dollar cost averaging into Bitcoin. And I want to make it very clear, while these are areas where we would start to feel comfortable getting a little bit risk on in the market, while everyone is getting fearful and selling and capitulating, people who are trading on leverage are getting liquidated, this would be where we get comfortable adding. But I want to make it very clear that this may not even be the lowest point. And I want to iterate this point as we go throughout the conversation here. Not only can we expect this to happen potentially for Bitcoin, but we can also expect much worse here for Ethereum, right? Just to get down to the traditional correction range we saw in the last bear market, we should expect Ethereum to come somewhere between $300 to $500. That's just at least in line with the previous bear market that we had. Not even talking about the potential uncharted territory we might be entering into if we step into the first ever real Bitcoin and Ethereum and cryptocurrency long-term depressionary bear market. I'm going to make that very clear here. I know my language might sound a bit extravagant and far out, and it might sound a bit too bearish, but it's important, even if this isn't going to happen, to be prepared for the question of what if. What if this does happen? Can you stomach this kind of correction? Can you hold through this? Can you dollar cost average at the right points? And can you not get yourself caught too overexposed too early on during the bear market, leaving yourself in a position where you're fearful and you end up selling your positions? The only reason I drag this out, guys, is because it's best to prepare for the worst. And on top of that, if you can be prepared for the worst, if you cannot be so eager to dollar cost average too early, to buy the dip too early, and have to get caught up in the mess of potentially selling at a loss at a bear market when many people are already down here from the recent correction. I can tell you guys, I've learned from experience, you'll be much better off if you can learn how to be patient and wait for the market to come to you and give you those great discount opportunities. Right now for Ethereum, we are only down 74%. And while that sounds like a great discount opportunity, as you can see here printed on the chart, it's important to understand just how much of a difference a few percentage points make from a top to bottom decline here as we go down in price, right? An 80% decline to a 90% decline may not sound like much, but it's the difference from $990 on Ethereum all the way down here to $490, a $500 difference here. A very, very big difference in the grand scheme of things. So again, want to iterate one key point here before we get into some of our broader topics here and build into this case for the weak argument for Bitcoin to climb higher here, right? We're starting to see here that Bitcoin, while it has bumped up to 19,200, we can see here that price has been relatively neutral, and market order flow has been absolutely disastrous here. We're remaining in negative 3,300 here on the cumulative volume delta. This is our partner tool bookmap here. You guys can check them out in the description. If you guys want to get these kind of market insights, use them for either short-term trades or for kind of long-term reads on the market alongside TradingView. It's one of my favorite tools, and you can get a 20% discount on it. But we like to take a look at it here on the Macro Monday, trying to analyze the past week here. As we can see, we're taking a look back here since September 19th, and market order flow has just been disastrous, meaning that more people across the major exchange order books, from FTX, from Binance, from Bitstamp, FTX and Kraken, all these big players, Coinbase Pro, we are seeing more net selling than buying when it comes to market order flow. People who are just taking the best available opportunity here, right? So there is still capitulation going on in the market. Now, if we can get a lot of bids coming in to provide support here for price, that will be very exciting. But to be honest with you all, the next level here where I see any kind of buyers coming in are down where we saw buyers last time, around $18,000 to the point. There really isn't much stuff here on the heat map. If we go ahead and emphasize the order book here, most of it comes down here at these lower price levels. And until we get down to that range here, right, I don't really see too much buyers coming into the market. I see a lot of sellers potentially coming in here at this range, right? So that's the key thing we need to understand is the order book is not speaking positively about crypto. Now, on top of that as well, another key point here that I think is important to analyze is the quarterly analysis for crypto. We are coming up on the quarterly close here in the month of September for July through September. And as we can see, obviously price has been lackluster. We faded any gains from the relief rally that we talked about back in July and August. We emphasized, we beat it like a drum, that we essentially are going to roll over once again, have a typical bear market relief rally that eventually gets faded. But it's important to understand here from a TA perspective, when we get towards these quarterly closes, that the chart is signaling that we're likely ready for lower moves here. Does anywhere on this chart look familiar to this quarterly close that we're about to have here for September? Let's take a look at the Bitcoin chart here. I want you guys to just look across here. If I was to point my fingers here, I would point here towards the quarter from April to June of 2018. And essentially from this point on, in a traditional quote-unquote crypto bear market, we had at a minimum a final 50% flush here before we came back down to the lows of the bear market, and finally we're able to start building the consolidation or essentially accumulation phase for Bitcoin to start moving higher and kick off the next bull market. If at a minimum we get that similar correction, I'm not saying it's going to be exactly like that, but I think we should expect at a minimum that we are going to be getting this. This would not only lead us to having an 85% correction in price, but would take us down towards that $10,000 big even level for Bitcoin's price. And this is why, again, we think that this is a very typical, not only range for a traditional Bitcoin bear market, but on top of that, it should be a level that we should easily expect here, considering the weight of equity markets going down over 40 to 50% potentially here over the next couple of months into the next year. We have to be prepared for this scenario here. And if we can get these opportunities, we should take advantage of it here. We should be getting more risk on when people are going to be risk off, when people are going to be capitulating, selling out of their positions. This is a big thing that we talked about as I went on to Coffee and Crypto with Tim and the team over there. They have a wonderful podcast where they go through and do long format conversations, bouncing back and forth between one another, kind of talking about the markets and their thoughts on things, the altcoins and plays that they're excited about in the market. And we had a really great banter and conversation back and forth around this conversation of just how bad things can get. We've been so caught up in a decade of euphoria and easy money that has allowed for the stimulation of assets to go to exacerbated levels. But many people have not experienced a long drawn out 2 to 3 depressionary bear market, 2 to 3 year depressionary bear market, where asset prices go down not just 15 to 30%, but they go down 50, 70%, or worse in some cases. So Just before we continue the conversation, if you guys haven't already, definitely consider subscribing to Coffee and Crypto. Hit that bell icon, check them out. You guys can check out the episode that we did together, and if you guys like that, definitely consider subscribing and check out more of their content. But essentially speaking, all I'm talking about here is a continued 27% correction from where we are, or from the all-time highs, at a minimum, a 50% correction in the NASDAQ, deviating slightly below the upward ascending line of support here, where buyers might start to come in and push us back in for the next bull market. This is exactly what we could expect here across the board in indices when we talk about a bear market for equities, a end of a secular bull market, right? The decade-long rally where the Fed was always able to come in and provide support. Now, there are some indicators here that are starting to signify to people that we might see some relief soon. The Dixie today, I gotta be honest, set in a terrible candle here for the dollar bulls, essentially, meaning that if the dollar's going down here or looking like it might start to trend lower for a little while, that could provide a window of time where equities and crypto maybe see a bit of relief here over the next couple days or week or so. But I have to tell you all, I don't care what crypto is going to do here over the next couple days, and I don't care about taking, I guess, per se, advantage here. Now that I'm in cash, taking advantage of a short-term bump in crypto. That's not how the greatest traders in history make their returns. And I'm not saying I'm one of the greatest traders. I'm just saying I take inspiration from people who make some of the sizable returns in equity and crypto. And they don't make it trading short-term bumps of hope or relief here in the market, right? The same here goes with commodities. Just because commodities are trending down here doesn't mean that the Federal Reserve is going to stop tightening. There is a lot of over-exacerbated costs for commodities still at these price levels. And on top of that, core PCE, price inflation, which Jerome Powell emphasized in the recent FOMC meeting as his key indicator to get down to the key target of 2%, right, is still at an elevated 4.56% as of July. We need to see this go down much further here over the coming months before we can start to get excited about the Federal Reserve potentially loosening monetary policy. Now, this leads me into a really important talking point here. One of the big kind of macro stories that happened at the close of last week was the comments from Wharton professor Jeremy Siegel. He got invited on to CNBC where they were basically asking him, what his thoughts were on Jerome Powell's comments. And I have to say, his rant and rave, which it certainly was a rant and rave, was really welcomed. I actually like a lot of what he said. I think he said what is on the minds of a lot of people when it comes to the frustration of the Federal Reserve, going extremely easy during the pandemic, injecting ridiculous amounts of easy money alongside the PPP loans that were out there. There's just so much abuse of the system and excess capital and speculation that led to Dogecoin being the headline cryptocurrency, meme stocks popping off. All of this was a result of Jerome Powell and the Federal Reserve's mistake of injecting too much easy money without principled window guidance of where that money could go, on what that money could be used for, and set restrictions on banks to make sure that they properly lent that money for productive purposes. But no, all it did is exacerbate the stock market when the underlying economy was suffering. And I completely agree with Jeremy Siegel's sentiment here that the Fed, in this case, is really going to be setting up the economy for a recession. We shouldn't be championing the Fed just because they're starting to do the right thing now, right? So that was Jeremy's key point here. And he made an argument, though, that I will start to disagree with, that the Fed is going too hard here, that they're going to force the economy into a recession, and that they're going to be too hawkish, essentially, increasing interest rates too quick, reducing the money supply, and crippling the underlying economy. And while I don't doubt that that is the reality, that is what the Fed is doing, I think Jeremy is wrong here in the sense that the Fed can avoid this, that it can essentially pivot. I don't think the Fed can do any of these things. If history is telling of anything, the Fed needs to be dramatic and swift, and it needs to reverse the excess that it put into the system. Simply put, there is not going to be any way we can escape long-term inflation unless we cool it down now. And as much as I think Jerome Powell, Neil Kashkari, all these guys from the Federal Reserve absolutely screwed up their response, and I think the world as a whole overreacted to the pandemic back in 2020. I think that is a clear statement at this point to make. That all being realized, it's in hindsight. And we need to do the right thing to be able to cool down inflation in the economy and bring back price stability and equilibrium between supply and demand in the economy. Now, I know a lot of people out there might say, similar to Jeremy Siegel, that Nick, isn't the Fed tightening too much though? Isn't it going too far here in trying to cool down the economy? Well, there is none other than one key metric we need to look at in order to understand if the Fed really has a grip on inflation in the economy, and it has to do with the housing market. Now, there are two charts that prove this here. Let's take a look here at the mortgage rates. You guys remember back here in kind of mid-2020, around May and June, when we were highlighting the mortgage rates here for a 30-year fixed rate mortgage were starting to go up to around 5%, the highest level here since as far back as 2009. Mortgage rates have leaped up 136%. 136% here since back in January 2021. From the lowest rate they had been in decades. And now we have leapt up over 136%. Now the cost to borrow is 136% more in real terms. The highest level since July of 2008. Highest level in over 14 years. Now, you would think that with mortgage rates ascending like this, that month over month, week by week, we should be seeing exacerbated levels of housing inventories on the market. We should be seeing a supply glut. And while we did see a rally here from back here in January of 2022, this is not only very typically in line with the rounded moves that we've had even during periods of easy money where housing inventories start to shoot up and the housing market slows. But what we saw here from July to August is a net decline in the available homes on the open market. A decline in the available homes. And we think that the Federal Reserve is tightening enough. Folks, I really want to make something clear. I know some of you guys have avidly watched the channel. If you're here at this point, I appreciate you guys must have built up a habit of tolerating my rambling. But I want to make a very clear point here as to why I'm so confident in this. I understand we were a bit behind the curve on calling the end of the crypto bear market. We were hopeful 30K would remain as support. Some of you guys may recall that, and I'll be the first one to mention it. That's why we talk about it here in the channel. I talk about where I get things right and where I get things wrong. But there's also a reason why we took advantage of that relief rally, and we were calling it out time and time again, because we are entering into uncharted territory here. There is still so much excess money out there in the system. There is still so much demand in the economy, consumer spending essentially, that has driven a lot of this inflation, that has driven the overt amount of demand in the housing market, and there's still nowhere near the supply to bring prices down. The Fed needs to get much more stern. They need to jack up mortgage rates by increasing the federal funds rate to around 7, 8, 9% territory that we haven't seen since back in the 90s. Only then will we get to a point where practically no one will want to buy homes. And then a lot of people who essentially bought homes to turn into rental properties, Airbnbs, all those people who, again, bought up a lot of assets, took as much credit as possible, who are renting out those properties, who are lending out those properties essentially to get some kind of yield, people won't be able to afford the fixed essentially rents that are going to come with that. And it is going to lead people renting less and therefore buying less properties. And in fact, selling more properties. It is going to allow for more supply to hit the market. And that is going to be exactly what the Fed needs to get in order to decrease the cost of living, decrease the PCE, and eventually put us into a situation where Bitcoin and Ethereum head towards much lower levels as people have to sell their more speculative or non-correlated assets similar to crypto. That's how you get a 50% top-to-bottom decline in equities. And that's how you get an 80, 85, 90% correction in crypto valuations. And we need to start getting prepared for that now more than ever. As Bitcoin not only rolls back to its lows, but the NASDAQ and S&P 500 come back to retest their lows from back in June. This is not a time to get optimistic and try to buy the dip. It's a time to listen to the trend and wait for the market to come to us and give us a better discount opportunity with our capital. The best traders and investors don't just try to buy the dip. The best traders and investors wait for the trend to confirm to them that it's time to put their money into the market machine and ride the wave for newer highs. That's how asset markets work. If we can't learn from that, if we can't understand that things could get a lot worse before they get better, we are in for a lot of pain to come. Anyways, that's it for today's video, guys. If you made it this far, consider dropping a like if you enjoyed my rambling. Even if you agree or disagree with me, guys, I'd love to hear from your thoughts down below in the comments. I don't mean to be too negative, but my job here, guys, although I'm not your financial advisor, I'm not here to tell you exactly what to do. My job is to give you guys the best opinion I can and to always prepare and ask not just how much money you can make in an investment, but talk about how much you can lose in the process. Anyways, everyone, that's it for today's video. Have a wonderful rest of your day, and I'll see you all in the next video. Take care, everyone.